So moving on to chapter 4, it's about taxes, planning your tax strategy. Just to kind of step back for a moment, what I want you to consider is that at this point in your life, you're probably not terribly concerned about taxes. Taxes are not, they're just not on the radar necessarily. Although, if you can recall the first time you ever had a paycheck, a real paycheck. If you haven't had one yet, then you'll see this at some point. But when you have a paycheck and you're earning a certain amount per hour, and you can do the math and figure out the number of hours that you worked and so on and so forth, and you have an expectation that you're going to be receiving a certain amount in your paycheck. But of course, what happens is you find out that it's significantly less than what your math was showing you in terms of payment per hour, and that is because taxes that are taken out, payroll taxes such as Social Security, Medicare taxes that are taken out, withholding taxes and the like. Taxes and the withholding would be for federal and state and so on and so forth. But again, bear in mind as we go through this that it may not impact you as much right now, but it will increasingly affect your the way that you view many things. You'll always have to consider the taxes, the tax consequences, and hence the term here, the tax strategy that you'll be employing going forward. So the learning objectives in chapter 4, we'll just walk through quickly. Learning objective 1, describe the importance of taxes for personal financial planning. Again, this is going to be something that's going to be second nature to you going forward. You're always going to be thinking about, well, I'm earning X amount of dollars per hour, per paycheck, etc. And then you'll learn very quickly that it's not really X amount of dollars, it's X amount of dollars less taxes. So 80%, for example, of what what you would be getting without taxes, because taxes, typically withholding taxes, would probably amount to on the area range of, the payroll taxes would be some, just using that as a guesstimate, 20%. But just that's the idea going forward. The learning objective 2, calculate taxable income and the amount owed for federal income tax. And we'll be walking through this again, each of these step by step. And the federal income taxes have changed in the last year, and there's always something that's afoot. Something is changing, whether it's at the federal, state, or sometimes even the local level, if you're paying a local income tax. And the step 3, of course, or the learning objective 3, is the preparation of your federal income tax return. Fortunately, we have access to such things as TurboTax, and they're relatively simple for the most part, individual income taxes. But there are some things to walk through and to be able to at least become familiar with that, with the forms that are associated, the process that is associated with filing your federal income tax. Identify the next number 4, identify tax assistance sources. And again, those are just like H&R Block, different resources that are available for you to help you to file your taxes, and anyways, for tax advice, etc. Finally, select appropriate tax strategies for the various financial and personal situations. Again, this changes as you're going forward. When you're single, earning a certain amount, and perhaps you get married, have a child, or have children, all these things change depending upon your status, if you will. So again, we'll start with 1, describe the importance of taxes. We've already gone through this, and it's interesting, about 1/3 of each dollar you earn goes to pay taxes. And this is on average, okay? This is, when we talk about this is something I bring up always in my economics courses. the overall, when you look at the overall, the national income for the U.S., for example, about a third of that goes to pay taxes at the federal, state, and local level. And it's not to say that you'll be paying a third, 33 1/3% of each dollar that you earn, but overall, on average, it is the 1/3 of each dollar. 33 cents of every dollar goes to taxes. Tax Freedom Day is mid-April and represents the portion of the year that people had to work to pay their taxes 1/3 of the year. Anyways, it's April, mid-April. And this is just like an FYI type of a thing. So for the first 3 months of the year, 3.5 months of the year, you are not those are the tax dollars. So you're working to pay for the operation of government taxes, right? Anyway, onward we go. So common goals related to tax planning: know the current tax laws and regulations that affect you. And these change all the time. You can look these up on, for example, at the federal level, it would be irs.gov. IRS meaning Internal Revenue Service.gov, irs.gov, maintain complete and appropriate tax records. What that means is that you hang on to these records so it will be at your fingertips, if you will, whether we're talking about paper or electronically. You're holding on to these records to help you to help smooth the process of actually, filing your taxes. As soon as I start talking about taxes, I start to yawn. Just kidding. Anyway, so for an example of this, and this is if you have a savings account, keeping track of what your interest that you earn, because that is what income. That's interest income, if you will, and that would also be something that you would incorporate and put into when you file your taxes. Anyway, make purchase and investment decisions that can reduce your tax liability. What this means is that, again, we'll be getting into this when we start talking about IRAs, individual retirement accounts. If we're going to be doing pre-tax or Roth IRAs are IRAs after taxes, but we'll talk about these as we go forward. So these are all things, again, that we're considering to help reduce the tax burden. Oftentimes, people, when they purchase a home, this is typically always the case. You're not going to be paying for the home with cash. You're going to have a mortgage, and that mortgage interest is something that is deductible. We'll be getting into tax credits, tax deductibility, and different terms that mean different things, if you will, so far as the tax treatment are concerned. Finally, target your tax planning efforts toward paying your fair share of taxes while taking advantage of tax benefits. What that means is that we are liable to pay our fair share of taxes and no more. If you want to pay more, you're welcome to do so. I was just thinking about this. If you want to help pay down the national debt or reduce its growth, if you will, you can always write a check to the Treasury Department toward that end, toward retirement of the national debt, of the federal debt. Anyway, I'm somewhat joking there, but the point again is that it's all about what we're doing here. We're discussing these things. It's all about tax avoidance, meaning avoid paying more than your fair share. Not tax evasion. Tax evasion is what? Tax evasion is against the law. But we are, again, trying to avoid paying more than our fair share of the taxes. Okay, so there are 4 types of taxes that the author talks about. One, taxes on purchases, sales taxes, and excise taxes. And that's pretty straightforward. Sales taxes, 6% in the state of Michigan, and it varies in in other states. Some states, like in California, if you're in jurisdictions such as like a San Francisco, they pay a higher tax. There's actually a local sales tax, if you will. Excise taxes are typically at the federal level. Federal excise taxes would be imposed on the purchase of tires, and I think that there are some also on your cell phone bill. I'm not quite sure about that, but they would certainly be on such things as tires. If you purchase tires, you'll look at the list of taxes. It will include sales taxes, excise taxes. Secondly, taxes on property. That would be real estate property tax and personal property tax. So real estate property tax is very straightforward. Property taxes on your home, and those are levied again by the state, and also in conjunction with your local with your municipality, if you will. Personal property taxes would be for such things as vehicles registration taxes, and so on and so forth. Third, taxes on wealth. So when we talk about income is what you earn over a period of time. What you earn per hour, what you earn per week, month, paycheck, per year, that is per something. So what you earn per a period of time. Wealth, so your income, I'm taking a bit of a sidestep here. Income, again, is what you earn for the use of your productive resource. In this case, we're talking about labor. And that income that you earn for the use of your labor over a period of time, your income goes to three places, right? Income goes to consumption. That's the biggest piece. Income also goes to taxes, which is a pretty good chunk. And there's not much left over for what? Saving. So the saving actually is the term in economics. There's no S on it. Ask me why, I couldn't tell you. I'm sure there's a good reason for it. So again, income goes to consumption, about 60%. It goes to taxes, 33 1/3%, and the balance of that, under much less than 10%, goes to saving. Okay, and the consumption is probably quite a bit higher than what I just stated at 60%, but we'll leave it at that. So when we talk about income, that is the taxes associated with income. Here, taxes, wealth, whatever's left over, that's saving, whatever you manage to save over a period of time, going forward. So you set aside something in saving, and whatever builds up, that is wealth. That is like the snapshot. It's like a balance sheet, where you're at, what your net worth is for that estate at that point in time. So the taxes would be associated with that would be estate taxes, and inheritance taxes, basically the same thing, but at the federal is what they're called their estate taxes, and at the state level, they're inheritance taxes. So if you want to pass on your savings, what you set aside to your children, for example, that would be your wealth. You would be passing on your wealth, and those are taxed at certain rates. And we'll get into that maybe a bit later, but again, all this is readily available, all the tax rates that are associated with it. Taxes on earnings, again, we already talked about that. Income tax, Social Security tax, these are what are called payroll taxes. Income tax, Social Security tax, Medicare tax. The income tax, actually the withholding, would be part of the payroll tax scheme. But anyways, taxes on earnings, those are the four types: purchases, property, wealth, and earnings, or income, if you will. Income tax fundamentals, calculate the taxable income and the amount owed for the federal income tax. This is on December 22nd, 2017, the Tax Cuts and Job Act, TCJA. It's funny how they always have these acronyms for these tax cuts, tax increases, etc., the different acts that are involved. So it included the reduction in the tax rates for individuals, larger standard deductions for all taxpayers, as well as limits to other more commonly used deductions. So the result of these tax cuts in 2017 that were passed, and the Lord knows what will happen going forward, but the point is, at this point in time, they still hold. And what that means is that the tax rates that were cut for individuals and for married couples, and anyways, so tax rates were cut, and the larger standard deduction, these are all things that were beneficial for us, the income earner, because when you're reducing taxes for the income earner, what that means is, again, what do you do with your income? You can spend it, consume it, taxes, so fewer taxes, that means you have more left over for what? Consumption and saving. Anyway, many of the changes are not considered permanent, could expire in 2025 if not extended. These are called sunset laws. Anyways, this gets into the kind of the nitty-gritty of the whole thing, but it's important to know that there was a tax cut in 2017. So determining your adjusted gross income. So adjusted gross income is what we do after we walk through, and we'll go through this in greater detail, identify taxable income, which is net income after deductions on which income tax is computed. So what we're saying is that we're taking our raw or our gross income, and we are going down from that to arrive at what is called our adjusted gross income after we take out certain deductions, etc. So types of income included in gross income. Remember, the gross income is what we see on our paycheck, if you will. So earned income includes wages, salaries, commission, fees, tips, or bonuses. So that's the income piece, so far as your labor is concerned. Investment income, also known as portfolio income, is the money from your dividends. That's financial capital, from your investments that you've made. Passive income is from business activities in which you do not have actively participated, such as this kind of gets into the weeds a bit, but it's important to understand that there are different types of income. Other income would include alimony, awards, lottery winnings. For example, the $1 billion lottery winner in Novi, Michigan. Wow, right? Anyway, so these are all these types of incomes. Again, income is what you're receiving over a period of time for the use of your productive resources. Labor, entrepreneurship, capital, physical capital, financial capital. This is investment income, and land, if you will, rent. Okay, types of income excluded from gross income. Exclusions are amounts that are not included in gross income. And in this case, for example, a portion of foreign earned income. And the reason, anyways, we won't get into that because you're being taxed by that other jurisdiction for this for your foreign income, for example. We'll get into that perhaps a bit later. Exclusions can also be tax exempt income, which is income not subject to federal income tax. For example, the interest earned on most state and city bonds, so municipal bonds. So those are tax exempt at the federal level. Okay, so if you, never mind, the point again being is that if you're buying these municipal bonds, state and city bonds, then they are tax exempt at the federal level. Type of income tax later. This is tax deferred income, and this is what we had talked before about an IRA. So, for example, if you manage to put $2,000 aside from your paycheck into your IRA, that is actually going to reduce your income, so long as it is a tax deferred IRA as opposed to a Roth IRA. And we'll get into that kind of going forward as well. All right, so adjusting that income, the adjusted gross income, or AGI, is gross income after certain reductions. So the things that we had kind of described earlier have been made. These reductions are called adjustments to income and include such things again as that IRA, penalties associated with withdrawal of savings, alimony payments, tax deferred retirement plans are also are a type of tax shelter, if you will. And this also impacts, of course, your adjusted gross income. So computing that taxable income after with the deductions, a tax deduction is an amount subtracted from adjusted gross income. So we have our AGI, our adjusted gross income, and from that we start deducting. We have tax deductions that will be associated with that. So we move from AGI to taxable income. So each taxpayer can subtract standard deduction, which is, I think it's $12,000 or 12,400. Anyways, $12,000 I think for an individual, and I think 24,000 for a married couple. At any rate, each taxpayer can subtract standard deductions, that amount on which no taxes are paid, or they can subtract total itemized deductions from the AGI. So itemized deductions is that if you have more deductions than your standard deduction, if you have a lot of medical expenses, so on and so forth, child care expenses, different expenses, school expenses, part of it as well, that you're able to reduce your if you have itemized deductions that are in excess of the standard deduction, you go with the itemized deduction is really what it comes down to. So itemized deductions, again, I should have gone through this, but itemized deductions include such things as medical, dental expenses greater than 10% of your AGI. So there are all these different bars that you have to cross in terms of having enough in terms of these deductions in order to itemize. By the way, most people use standard deduction, probably I think on the order of 80% of personal income tax filers. So 80% of the normal folk out there file using the standard deduction. At any rate, taxes, these other deductions, taxes, state and local income taxes, it's called SALT. State, local income taxes, real estate property taxes, or local personal property tax. Interest, mortgage interest, home equity loan interest, so interest on that mortgage that we'd already talked about before. Contributions to qualified charities, so be generous with your charitable donations, especially if there are some positive tax consequences for you. Anyways, it's just a little bit of something to sweeten or lessen the pain, if you will. Anyway, moving expenses, so if you're moving for work, so on and so forth, or job-related and other miscellaneous expenses greater than 2% of AGI. So there are all these possible deductions that could flow into an itemized deduction if you and you would go ahead and itemize your deductions if they are in excess of your standard deduction. Exemptions. So exemptions, this is for tax year prior to 20, an exemption was allowed as a deduction from adjusted gross income for yourself, your spouse, and qualified dependents. These were eliminated again with this, with the changes with the tax law in 2017. They were eliminated with the TCJA, and the standard deduction were increased significantly instead. So they get rid of the exemptions, and you have a very high, relatively high standard deduction that kind of covers the waterfront, if you will. Qualified business income to provide a benefit to small business owners. A new provision called Section 199A permits owners of sole proprietorships, S-corps. Sole proprietorships are sole owners. S-corps, corporations rather, are incorporated in or partnerships to deduct up to 20% of the income earned by the business for their individual return to arrive at taxable income. Point being is that there are some set-asides, this exemption for small businesses to encourage small business. Small business is the heart and soul of the economy in many, many ways. I believe it's, I always get this number wrong, but let's just say it's over half of all people that are work for small businesses, for example. Small business, I forget the actual criteria, but it could be one person up to, I forget, we'll just say up to 100 people would probably be counted as a small business. So after deducting amounts of exemptions, you arrive again at your taxable income. That's the amount you use to determine the taxes that you actually owe. All right. This is on the income side. So you're calculating your taxable income. This is just an example that we're walking through. So your gross income, wages, profits, dividend, interest, other income, sounds good, $81,050. Less an adjustment to income, that's your retirement plan contribution. So we'll just say that it's a couple. So this is a married couple, and so they're both kicking in $22.50 for their IRA for their retirement. So that reduces their gross income down to their adjusted gross income of $76,550. And then comes a deduction. They're using standard deduction again for a couple. I guess it was right. I thought it was a little bit more than that, but $24,000. And from that, so you're subtracting that, getting down to that taxable income, the taxable income of $52,550. So now we're on to the taxes that you actually that are actually owed. How you're going to be, how much you're actually going to have to pay. So using your taxable income, use your taxable income with the appropriate tax table or tax schedule. There's 7 tax rates, 10, 15. This is their percentages: 10%, 15%, 25, 28, 33, 35. 39.6, and they are called, again, marginal rates. You see that in boldface because what we're looking at is we'll walk through this. For example, after deductions and exemptions, the person in the 28% bracket pays 28 cents in taxes for every dollar of taxable income in that bracket, very specifically in that bracket that we're talking about, right? So we'll walk through this. So each of the tax brackets represents a range of income levels or brackets. The person's average tax rate is based on total tax due. For example, we'll walk through. A person with a taxable income of $40,000 and a total tax bill of $4,740 would have an average tax rate of 11.85%. Again, 4,740 divided by 4,000. The average tax rate is less than a person's marginal rate, except in that lowest bracket, that 10% bracket. Taxpayers who receive tax breaks may be subject to alternative minimum tax, or AMT, to ensure that they pay their fair share of taxes. And that's when you get to a bit higher income, nothing to worry about at the moment, but something to keep in mind, that AMT, that alternative minimum tax. And at any rate, tax credits. Tax credits are where we talked about deductibilities, deductions, That's reducing your income, and from that you're going to be taxed at a certain rate. Tax credits are different. Tax credit is an amount subtracted directly from the amount of taxes owed. For example, the EIC, or the earned income tax, this is for low income earners, etc. So tax credits versus tax deductions, let's walk through it. $100 tax credit reduces your taxes. So you figure out your taxes. You owe $1,000, for example, and after doing all your calculations, and you have a tax credit of $100, so it reduces that tax burden from $1,000 down to $900. At any rate, the tax deduction reduces your taxes by $25 if you're in the 25% bracket. So the point again is that we're looking at the credit is straight dollar for dollar. Deduction, you're looking at it in terms of the percentages, where you're at in terms of your marginal tax rate. So examples of tax credits: foreign tax, because again, if that income, you're paying taxes on it in a foreign jurisdiction. There are different reasons, but child and dependent care taxes, care expenses, savers tax credit for retirement contributions, adoption expenses, American Opportunity and Lifetime, different labels on all of these, right? So again, these there are various tax credits that reduce your tax liability, period. Tax credits are always a good thing. The tax credits are more desirable, of course, than tax deductions. Tax deductions reduce your taxes by the tax bracket that you're in, whereas tax credits reduce your overall tax by whatever amount that credit is. So tax payments and deadlines, making tax payments, withholding taxes, estimated payments. Withholding taxes are taken out of every paycheck. As you're earning income, there are taxes that are withheld, that are set aside, paid to the local, perhaps, the city, state, and federal. There's withholding taxes. And also the estimated payments would be associated with, we won't get into that, but you're estimating your taxes for a specific quarter. Typically, when we talk about taxes, they look at taxes on a quarterly basis, meaning from a quarter means from January through March, April through June, July through September, October through December. Those are quarters, the years in 3-month increments, if you will. So you estimate your taxes based on income perhaps that you earn that you weren't having some money withheld. Anyway, deadlines and penalties. Most people are required to file their taxes, federal taxes, April 15. You can also, again, file extensions, but when you file your extensions, you have to estimate your taxes and pay your estimated amount, best guess estimate of what your taxes would be. So finally, failure to file a tax, your tax return can result in 25% penalty in addition to the taxes owed. So what that means is that if you actually owe taxes and you don't pay on time on the 15th of April or whatnot at the federal level on your federal taxes, then you would be subject to a penalty. Plus, of course, having to pay whatever taxes that you owe. So in this instance, we're looking at a W-2 form. This is something that if you're not familiar with it, you will be as you go forward. So it starts with, they're all pretty much laid out the same way. This is coming from your employer, and there are different boxes, and you follow the boxes as you go through. Your social security number and your employer identification number, your EIN, and there are also down below, there's the employer state ID number, and walking through, of course, the employer itself, the wages and tips and other compensation. This is your gross income, if you will. And Social Security wages. You'll notice that Social Security wages are higher than the other wages, and that's that would be because there's some discrepancy between the two, a difference of $6,000. At any rate, the federal income tax withheld, how much is taken out of your paychecks, and Social Security taxes withheld. Again, these are payroll taxes, Medicare tax withheld. And all these withholding, these are being withheld. And in addition to that, that's just on the federal side. Down below, there's also state taxes that are withheld, the state withholding taxes, or can be, if you will. Anyway, this is your W-2 form, an example of a W-2 form. In this case, it's for Barbara Victor. Okay, again, so on where we go. Filing your federal income tax return. Everyone is either, well, you're required if you're under a certain income, you're not necessarily required to file income taxes, but it's a good practice to get into regardless. If you're not, even if you're earning a very, very small amount, it's pretty easy to go through this process. There are easy forms, etc., but literally easy form, right? Anyway. Anyway, so onward, who must file? These are the 5 filing status categories. Single, so if you're single, divorced, legally separated, married, filing jointly. So this is something I didn't really want to get into here, but they did bring it up. The marriage penalty often occurs for couples that have similar income levels. The penalty is the amount of additional tax that a couple will pay using a married filing joint status versus a single filing status. And what that means is that if you're filing jointly, some cases, it's not quite this case, not quite the way, but there is some sort of there is a penalty of sorts, or there can be a penalty of sorts where you're paying not necessarily double the taxes, but you're paying more taxes. So it's just there. It's not always the case, but it's something to kind of keep in mind. That there is something that's a term called the marriage penalty, and these are things that you figure out whether or not it makes more sense to file again either married filing joint return or married filing separate returns. It's pretty straightforward. Head of household is an unmarried individual who maintains a household for a child or dependent relative. Could be divorced person, with a child, etc. And finally, qualifying widow or widower, and that's those are the statuses, if you will, the 5 statuses, the types of people that are filing taxes. So you select the tax form, tax cuts, and anyways, the forms are straightforward. The 1040 form, the 1040EZ, or the 1040A. Those are the forms individuals or the personal taxes that income tax that you would be filling out. Again, the 1040 form is the general term, and there are different types. The EZ is a very, very, very simple form. It's gone from all those down to the 1040 form. There's still about 800 federal forms and schedules to report additional income, and it's mind-numbing going through the different types of income that you can, that different attachments and so on and so forth, depending upon what the criteria are. So completing the federal income tax return, filing status and exemptions. So this is the process: the filing status and exemptions, the income adjustments to that income, the tax computation, other taxes, which include self-employment taxes and tax credits, payments, total withholding, estimated payments, etc. The refund or the amount you owe. Refunds can be sent directly to your bank, so you can have automatic deposit through your bank. And lastly, of course, that when you're signing your return, and a lot of times that's done electronically, but you get the idea. So these are the steps that go through in your federal tax return. So correcting your federal return. And it's funny, it says occasionally you'll discover that income was not reported, or you have some changes that have to be done. And what you have to do then is file it's called a 1040X, and what that is it's an amendment. Is you're amending your tax return. The form is designed again to amend the previous file. This happens. It's not something to be scared about. This it's something to if you forget some income, for example, you file the 1040X. And you do this typically of your own accord. Don't wait for the IRS to find out and audit you and so on and so on. Nothing to be scared of. It's just another step that you have to go through. So that's it with the federal. It's not as straightforward, but we kind of walk through the process, and now we're looking at the state income tax returns. All states have state income tax except for 7, and that may actually be changed. There may be 1 or 2 more, or 1 or 2 less at this point, but in general, most states have income taxes. I think state of Florida doesn't have a state income tax. Texas, I think Nevada. I may be wrong about Florida and or Texas, but I know Nevada does not have a state income tax. Anyway, taxes range from 1% to 10% based on, again, back to that AGI, or that adjusted gross income or taxable income from the federal income tax return. So they're basing this on your federal income taxes, and it's usually due about the same time federal income tax return is due. In Michigan, for example, I think it's on the federal income tax, the date where taxes are due, April 15th, filing. And for the state of Michigan, I believe it's the 30th of April. But things changed last year with COVID, et cetera. Things happen. So at any rate, they're pretty much set in stone though. So the 10th, the 15th for the federal, and I think the 30th for the state. Tax assistance and audit process. So again, you're identifying tax assistance sources. In the process of completing your federal income tax return, you may seek additional information or assistance. And this is available irs.gov, or typically you could turn to like a tax software, like a TurboTax type of a scenario, or H&R Block. You can go in to get assistance, and oftentimes communities have tax people that volunteer to help people file their taxes. So after you're done filing your taxes, you may be identified, for a tax audit. If this happens, several policies and procedures protect your rights. It's nothing to be scared of. It's just, this is why you try to keep everything in order so far as your taxes are concerned. You compile your all of your records. You keep your records at hand, if you will, for backing to support your tax filing for the audit purpose. Sometimes audits reveal that you overpaid. Sometimes the other way around, but at any rate, the audit is a process where you're selected because it's standing out for some reason or another. So tax information sources, again, we talked about the IRS, irs.gov, and you can always call this in, so on and so forth. And there are lots of tax guides that are available online, like Kiplinger's is out there, it's available, and there are a zillion tax preparation apps out there. And again, TurboTax is the one I always use, and it's probably what your friends or family, they probably use the same TurboTax, or maybe go to someone to prepare their taxes for them, an H&R Block or something like that. So the tax preparation software today, most taxpayers use computers for tax record keeping. Spreadsheets, TurboTax, TaxCut are popular methods. Consider your personal situation, special tax situations. If you have a particularly complicated taxes, oftentimes it's wise to seek out some help, some professional, like a CPA type of a scenario, right? At any rate, there's a lot that's available, and I've been very lucky with TurboTax. It seems to work pretty well, along with my record keeping. Oftentimes, record keeping for me is keeping copies of medical payments, for example, that are above and beyond what my insurance would cover. And at any rate, you can have paper record keeping, or you can keep track spreadsheets. Oftentimes now with bank accounts online, you can organize through your bank account. You can go through and download all your checks, your check register, if you will, and separate things out that way. At any rate, so as far as the preparation services, one-person office to national firms such as H&R Block, government-approved tax experts, accountants, attorneys. There are just numerous tax preparation services that are available out there, and they're not cheap, so keep that in mind too. H&R Block is pretty reasonable, but oftentimes it can get pretty pricey if you need someone to help walk through your taxes. So how to file your taxes online, and there's always the free file option, and free file option is pretty straightforward, and that's at the federal level. Keep that in mind. You can file your taxes for free, and those are the steps that there's a ton of software out there, again, for filing taxes online, and oftentimes that software that's available, I think even TurboTax has something, but you can go directly through IRS and do this as well. especially if your taxes are extremely simple. The second option that they talked about here was e-file. E-file is there are again free filing forms, and then there's the paid prepare e-file or purchase software. Again, I use TurboTax, and all these are the main thrust behind this is that it's something to simplify things. It's online, and you would be filing taxes electronically, if you will, through the IRS, through the Internal Revenue Service at the federal level, and also at the state level, for example. But you can always do paper. You can print things out and mail them in. So even the tax service warnings, you hear ads all the time. And there's this, as we walk through, even if you hire a professional tax preparer, you're responsible for supplying accurate and complete information. Preparer will not guarantee that you pay the correct amount. So it's really on you at the end of the day. They organize things, put them in order for you, and they're asking you for the information and compiling the information and plugging it in, if you will, to the various forms. That's really what it boils down to. So what if your return is audited, the tax audit? It's a very small percentage, but it's just the same, it happens. So if there are any things that are oddball things that you have very large deductions, for example, if you have thousands of dollars worth of charitable deductions, you better make sure that you have backup detail for those deductions, because they do throw up the red flags, if you will, for the IRS. And there are a lot of things that cause red flags, but definitely if you claim the large or unusual deductions, that's going to cause a red flag. So the audits take place at I haven't had to do this myself, but I've had friends that have had to go through audits at the IRS at the IRS office rather. And you have rights, of course, as you go through this, but they're very much sticklers in making sure that the information is available for that they're asking for. They want that information, so keep that in mind. This is why we keep records. So learning objective 5: select appropriate tax strategies for various financial and personal situations. And this is what I had talked about this before. Legally, you practice tax avoidance, right? So you're looking to reduce your taxes as much as possible. Don't overpay your taxes. Don't overpay. I tend to overpay a bit. I kind of pay attention to detail on this too. But when I say that, I mean I tend to err on the conservative side. So, for example, if I have charitable deductions of $1,000, I try to and if I don't have, exactly $1,000 worth of receipts, I just go with whatever amount I have for receipts, $900 worth of receipts. Then that's what I file my for my deductions, an example. So you're avoiding taxes, and you're not in the bottom, the illegal. You're not practicing. You're not evading taxes. You're not going so far as to break the law. That's the objective. Minimizing taxes owed. To minimize taxes owed, there are different strategies. Again, they're talking about accelerating deductions if you expect to have the same or lower tax rate next year. For example, you can throw more deductions into this year, right? Delay the receipt of income if you expect to have the same or lower tax rate next year. You can push some of your income, if you're able to do that, into the following year. Delayed deductions if you expect to have higher tax rate next year. So you can push those off. And when I say these things, you can consciously plan to do this. Meaning, if you're going to donate $1,000 and it's in December, and you find out that, well, next year I'm going to have a significantly higher income, maybe I'll push that deduction, that $1,000, into the January. make that charitable donation in January of the next year rather than this calendar year. Accelerate the receipt of income. If you expect to have a higher tax rate next year, try to, if you can do so. And these are all things that are, most people don't have the option. But however, having said that, these are things to kind of think about as you have more income, and if you perhaps you have more flexibility in your income, if you're a small business owner, etc. Consumer purchasing, place of residence, homeowners, mortgage, interest, and property tax are deductible when you itemize. This reduces your taxable income. Consumer debt, use home equity loan to buy a car or consolidate debt. Interest can be deducted on your taxes. Job-related expenses may be allowed as itemized deductions. Again, when we're talking about itemized deductions, that's above and beyond the standard deduction, but these are all things to kind of keep in mind. Healthcare expenses, flexible spending accounts, that's paying for your medical expenses with pre-tax dollars, meaning you're reducing your income. You're reducing your AGI, adjusted gross income, and paying for things prior to taxes, so you're avoiding taxes, right? Investment decisions, tax and exempt investments, interest income, municipal and state bonds. Or I shouldn't say municipal bonds include state and local bonds. But they're not subject to federal income taxes. Interest on savings bonds are exempt from federal income tax if used for tuition. I don't even know anybody who uses savings bonds anymore, but it's just the same. It's another tool that's out there. Tax deferred interest, that's tax deferred annuities, Section 529 savings plans for child's education, IRA savings plans, or IRA plans, 401 plans, 401k plans rather, and capital gains, this last piece that they're looking at, are profits from the sale of stocks, bonds, real estate, or taxes paid when sold. What that means is that, say for example, you bought a stock 5 years ago or 10 years ago for $10, and the value of that stock has risen from $10 up to $100. The capital gain on that stock is the difference between the purchase price and the sale price. So you're selling it at $100, you bought it at $10. That means you realized a capital gain of $90. So that's, by the way, when we're talking about stocks and we talk about how you earn money, income on stocks, two ways. One is a dividend, that's an annual or however semi-annual, quarterly payment, typically semi-annual or annual, maybe both. And what I mean is that those are payments that are profits, if you will, that are passed along to you from the company if you own shares of stock. The other, again, is this capital gains, where the value of the stock itself is rising. Okay, investment decision, part 2 of 2, rather, self-employment. If you own your own business, you may be allowed to, it would allow you to deduct your health insurance as business costs. However, you have to pay self-employment taxes. That's Social Security in addition to the regular tax rate. What that means is that, for example, Social Security, I wish I had the numbers in front of me. We'll just say 13% in total we'll say 14% total for Social Security and Medicare. Half of that is paid by you, the employee, 7% or whatever. I think that's pretty close to the number. Might be like 7.25%, but you get the idea. So 7% is paid by you, the employee, and 7% is paid by your employer. So if you're self-employed, you get the pleasure of paying for both sides of that. The employee portion and also the employer portion. So you pay the full freight on Social Security. Children's investment, income shifting, child under 18 with investment income more than $2,100 is taxed at a rate that's applicable to estates and trusts, which means that it's much less. So if you're investing for your child that's under 18 years of age, what happens when they're 18? They spend it all, but I'm joking. But you get the idea. There are some different strategies that can involve with investments. Retirement and education plans, this is a list of the different plans that would be out there. A traditional IRA, individual retirement account. A Roth IRA. Roth IRA is that you're paying for your individual retirement account with after-tax dollars. There are different criteria that go along with this, but the main idea is that you're setting this aside and you can't touch this money until you're 59 and a half. If you try to withdraw it earlier than that, you would be paying penalties on that. I forget I think it's about a 10% rate, but it's still significant. The Coverdell Educational Savings Account, 529 plan, these are education for kids. The KEO plan is for, I believe the KEO is for self-employed, and your 401k plan would be for those folks that are working for a company and the company has some retirement plan set aside for you where you would be, they would either be contributing something on their side or matching your contributions or just have something set up for you to be able to save, if you will, into a retirement plan. So just to summarize these tax strategies: time and receipt of income, the payment of taxable expenses in relation to your current and future tax rate. All this is that we're talking about. This is the actual planning, what we're doing, what we're trying to get a roadmap, if you will, so far as like what your taxes are and trying to reduce what your tax liability, how many taxes you owe, kind of going forward. So taking advantage of those tax credits for which you qualify. Tax credits are always very, very welcome, right? Tax deductions are fine, but tax credits are much more. They impact your bottom line in a much more favorable way than do deductions. Consider tax-exempt investments such as municipal bonds, so that municipal bonds are not taxable at the federal level. These again are things that are probably not going to impact you right now, but things to kind of consider, have it in your mind. Defer capital gains and accelerate capital losses. Deferring capital gains meaning trying to push your if you're going to be selling a share of stock, pushing that out further, the actual tax burden that would be associated with it. Capital losses, if the value of your stock goes down, for example, and you experience a capital loss, then you can try to accelerate that to reduce your tax liability, if you will. Anyways, not that you want that, but this is what we're talking about. Taking advantage of tax benefits of owning your own business. Again, because when you own your own business, you would be there are different taxes that would apply, and there are different tax strategies, schemes, in a good way, that would be advantageous to you. And this is really something to think about. I encourage everyone, if you have an interest in starting your own business or starting a small business or whatnot, to work on that as best you can. Business plans, so on and so forth. At any rate, planned purchases such as house or healthcare with tax implications in mind. Again, it's not the taxes are going to drive everything, but you have to consider them, right? And search out all possible itemized deductions. I've reached the point where I'm content with my standard deduction, but I do occasionally walk through to see if I have enough itemized deductions to go over the standard deduction limit, and at least in recent years has not been the case. Okay,